Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, February 21st, just after the close. A little more softness this week on the equity side of the market. We've been discussing that for the last couple of weeks. While indexes were continuing to make new highs, we did see some softness, and some of the new highs versus new lows start to register a touch of weakness. So that continued this week. Nothing that gets us overly concerned. Remember, we like to look at capital in buckets: short term, intermediate term, long term. None of the action this week would make any allocation changes to our long term and intermediate term decisions on equities. Short term, as we've started to see some of the analytical activity over the last, let's call it 3 or 4 weeks, in our tactical strategy, which can move amongst asset classes. We did raise cash. We're sitting at about 22-23% cash there. A couple of things to note, and we've been fairly consistent here. We hit very strong overbought numbers on the S&P, on the Dow, especially in the NASDAQ, that first half into the early second half of January. We're currently working those numbers off. A market can correct through price or time, or a combination of both. Currently, time is working that overbought number off. We have the opposite in the fixed income market. I want to share a couple of charts with you today. Initially, we'll take a quick look at the U.S. 10-year yield chart. Take a look at that highlighted area down around 145. We've revisited the summer lows in the 10-year Treasury. Now, that normally will bring out a lot of recession talk from different market commentators and portfolio managers and financial TV shows. Keep in mind, the gravity of foreign yields is a force that we battle with. The U.S. interest rate market battles with now on a daily basis. Take a look up in that right-hand corner of our U.S. Treasury yield index. Italy, 10-year yield, 0.91%. Greece, 10-year yield, 0.92%. These are triple B and double B credit countries trading at 50-plus basis points below where our 10-year is. Very difficult for our 10-year to stay elevated. So does it give us a thought that there's weakness economically around the corner? I don't know the answer to that. What I do know is there's a lot of foreign money that needs investment grade type of paper just pummeling our market with demand. Demand, demand, demand. Keep in mind, we started the year out up in, right in the 195 area. So we've dropped 50 basis points the first 6-7 weeks of the year in the Treasury market, yield market. That's good strength for bonds we own, price-wise, but it makes it difficult to find very attractive yields. Spoke to John Musso earlier today. As you know, John's on often, Director of Fixed Income. If we continue to see these kind of bids, this voracious appetite for paper, you may see us selling into it over the next week or two. Not wholesale, just locking in some profit. So that's something to take a look at. Keep in mind, we are at an area circled under that weekly overbought, oversold area on Treasuries at 0.83, a negative 83 in yield, where we may start to see that level off. So something to keep an eye on. We don't trade in a vacuum, always taking a look at interest rates. The other's gold. We did see an appetite for defensive asset classes this week. Take a look at gold. I put a chart up there for you to take a look at. GLD, the heavily traded SPDR ETF. We're really looking at 5-year highs in gold. Again, interesting. Do we make decisions based on what gold is doing? Absolutely not. Do we respect that capital currently is flowing into defensive areas, gold, silver, treasuries, absolutely. If we're not paying attention to that, we're not doing a proper job for you. So, intermediate, long term, trends on equities, still positive. Relative strength versus cash, still positive. In our U.S. portfolio, we're 95–96% invested. In our tactical portfolio, we have raised cash, just looking for a more reasonable re-entry. We're about 20–22% cash there. So everyone have a great weekend. We'll see what happens next week. One thing I did mention to our newer clients, on new accounts over the last 5 or 6 weeks, we were only getting a third to a half invested. That may change if we get any continued weakness. You'll see some capital being pushed into the sectors that we're comfortable with on a relative strength basis. Enjoy the weekend. Talk to you next week. Hi, quick note on the heels of our Global Markets Conference last week, which, by the way, videos are available on our site. On March 20th, we're going to drill down into energy and the trading opportunities both on oil, natural gas, solar, and wind energy. We have some prominent leading experts in this different area, both from academia and from the trading world. We'll try to see if there's opportunity, how we can assess that opportunity, how we can allocate capital to that opportunity. So we're drilling down into energy. It will be at the University of South Florida, Sarasota, Manatee, and we have a knockout lineup. So we'll provide a link to that. We'd love to see you there.